Stage 3, the machine room.
Part 2, the final part. Last time, things were just getting started, but this is where everything changes. If you missed part 1, the link is in the description below. A few more years go by. You're 37 now, maybe 38. Old enough that your back reminds you of that paint roller every time you bend over. Young enough to still climb stairs without groaning, mostly. The duplex became a fourplex. You scaled up slowly, one unit at a time, one late-night repair call at a time. You don't do the painting yourself anymore. There's a guy named Luis for that now. But some evenings, you still walk the property, just to look at it, just to feel it. That's when your phone buzzes with a tax notification. You squint, scroll up, scroll down, you even tilt the phone a little like that's gonna change the math. The number you owe is almost nothing. The cash in your account says something else entirely. And that's when you realize you've crossed a line you didn't even know was there. Net worth north of $100,000. The writers call this restaurant freedom. You can order the appetizer without doing mental math on the tip split. It's a small thing, but again, small things compound. And you've done something that the wealthy genuinely, deeply love. More than yachts, more than private jets, more than any of the flashy nonsense you see on Instagram. You've bought depreciable real estate. And this is where the tax code stops being an obstacle, something to be navigated, endured, complained about, and starts being your personal ATM, a machine that generates tax-free cash while you sleep. Your accountant shows you how it works. You bought that fourplex for $500,000. The land's worth $100,000. The building, $400,000. The IRS, in its peculiar wisdom, says that building is slowly wearing out. Every year, the roof ages, the floorboards creak a little louder, even though it's actually going up in market value. They let you deduct that imaginary wear and tear. It's called depreciation, a phantom expense. You didn't write a check for it, you didn't swipe a card, it's just there. For residential property, you divide the building value by 27.5 years. That's about $14,500 a year you subtract from your rental income. You collected $40,000 in rent. After mortgage interest, taxes, insurance, repairs, and that depreciation, your taxable income might be close to zero, maybe even negative. But the cash, the actual dollars, they're in your account, spendable, real. You can reinvest them. You can take that vacation you've been putting off, and the government pretends they don't exist. This is phantom cash flow, and it is one of the most beautiful phrases in the English language. Wait, there's a layer cake here, and we've only had the first slice. Your accountant mentioned something called a cost segregation study. You hire a firm, they walk through your building and identify things that wear out faster. Carpeting, 5-year property. Appliances, 5 years. The driveway, the fencing, the landscaping, 15-year property. Suddenly, instead of depreciating everything over 27.5 years, you identify maybe $100,000 of components that can be depreciated much faster. And with bonus depreciation, you can write off a massive chunk of those short-life assets in year 1. You might show a $50,000 paper loss on your tax return, while $30,000 in actual cash went into your pocket, tax-free. That's not evasion. That's the Internal Revenue Code working exactly as written for the people who bothered to learn how to read it. And when you're ready for something bigger, when you've built enough equity and you're ready for a 20-unit building or a small apartment complex, you don't sell the fourplex, you swap it. Section 1031, the like-kind exchange, sometimes called swap till you drop. You sell the fourplex, but, and this is the crucial part, the part that makes the whole thing work, you never touch the cash. It goes to a middleman, a qualified intermediary. And then the clock starts. 45 days to identify a replacement property. That's it. You're driving around on weekends, walking through buildings that smell like old carpet and fresh paint, checking your watch, making offers. 180 days total to close. The pressure's real, but so is the payoff. Because the capital gains tax that would have been due, potentially tens of thousands of dollars, is deferred, not eliminated, deferred. The tax liability attaches to the new, larger property and travels with it. And if you do this again and again and again, each time rolling your equity into something bigger, something more valuable, you can defer those taxes forever. Or at least until you die. And that's the part nobody told you about. Stage 4. The room where the map is kept. More years pass. Quite a few of them, actually. You're 47 now, or maybe 51. The math gets fuzzy when you stop counting candles and start counting assets. What you count now are units, doors, the quiet hum of things working while you sleep. The fourplex became a 12-unit, then a small complex. You kept swapping, kept borrowing, kept holding. The late-night repair calls still happen, but now you're the one calling the plumber, not the one holding the wrench. One day, you look up and you're in a different kind of room. Glass walls, the city spread out below like a circuit board. A quiet meeting. 3 people around a polished table, a lawyer, a financial advisor with kind eyes, and you. They're your family office now. Maybe just 2 or 3 people who answer emails faster than you do. The lawyer pours water into a glass. No ice. You notice the weight of the pen in your hand, heavy and cool. This is where the map is kept. You're holding $15 million in public stocks. You bought them for $2 million way back when you were still holding a paint roller and wondering if you'd ever get the agreeable gray off your fingernails. There's a $13 million gain sitting there, untaxed, quiet. If you sold, you'd light about $4 million on fire just in taxes. So you don't, you borrow against it, a $2 million line of credit. You use it to pay for your life, the kids' private school, the family trips, the donation to the new museum wing that you got named after your grandmother, not yourself. You're not flashy, that's not the point. The portfolio grows at 7 or 8%, the loan costs 6%. You're playing the spread, tax-free. It's almost too simple. But today's meeting is about death. The lawyer sets down the glass. He's calm. He's had this conversation 1,000 times. Let's talk about the irrevocable trust. You flinch. You can't help it. Irrevocable means I can't change it. I spent 30 years building this. He smiles, patient. I know. Everyone says that. But let me show you the alternative, the math of doing nothing. He slides a single page across the table. If you keep this stock in your name and you die, the IRS values your state. The exemption is about $14 million per person right now, going up to $15 million next year. Everything above that taxed at 40%. 40% of $15 million is $6 million gone. Not to your kids, to the Treasury. You sit with that. We gift the asset to the trust now, he says. It leaves your estate protected from that 40%, protected from creditors, from lawsuits. But can I still benefit? The lawyer glances at the advisor, a small, knowing look. The trust can distribute income to your spouse and children, and it can make loans back to you. You lean back. The pen is still in your hand, but you're not holding it so tightly anymore. You just built a generational ATM, a machine that dispenses wealth to your family decade after decade that the IRS cannot easily reach. You stand up and walk to the window. Every car down there, every person on that sidewalk, they're playing the game you used to play, trading hours for dollars, selling when life happens. You're playing a different game now. You're trying to figure out how to borrow $5 million to acquire a business without triggering a tax bill on the $15 million you already hold. You're trying to figure out how your grandkids will benefit from what you built. The city looks different from up here, quieter, like you can finally see the whole board. Stage 5, the reset. This is the end of the timeline, but not the end of the asset. You held the stock. You borrowed, you swapped, you trusted, and now, decades later, your heart slows. The beeping on the monitor is steady, but you can feel it, the gradual unwinding of a body that carried you through all of this. You think about the duplex, the smell of fresh, agreeable gray, the way the light came through those windows in the late afternoon. Luis whistling while he worked, something in Spanish you never quite caught the words to, but always recognized the tune. The weight of the keys in your hand the first time you stood in that empty living room and thought, this is mine. And the tax code, in its peculiar, decades-in-the-making wisdom, saves its best move for last. Section 1014, the step-up in basis. That $15 million portfolio, the one you bought for $2 million, with the $13 million gain you protected your whole life, you die. Your daughter inherits it, and the clock resets. The $13 million gain is wiped out, extinguished, forgiven. It does not exist anymore. She can sell it all tomorrow. The tax bill on that gain? $0. She takes the cash, pays off the loan, and keeps it, tax-free. Or, and this is what you hoped she learned watching you all those years, she holds it, borrows against it, keeps the machine running. Remember that number from the parking lot? That 3.4% effective tax rate the wealthiest Americans pay while everyone else pays 22, 24, 30%? Now you know how it's done. Not with secrecy, with structure. You lived a life full, spending borrowed money you never paid income tax on, and in death, you made the capital gains tax disappear. This isn't a conspiracy, it's the Internal Revenue Code. It's been this way for decades. Closing words. So, here we are. You've walked through the rooms, felt the repair estimate in the parking lot at 29, heard the banker's voice at 32, held the paint roller, scaled the fourplex at 37, sat in the glass-walled room at 47 with the heavy pen in your hand. You've seen the whole board. The question isn't, how do I get rich? It's, what is the first asset I will buy and never, ever sell? Maybe one share. Maybe that duplex. Maybe just the decision right now to stop liquidating and start stewarding. You don't need 10 million to start. You just need to understand the rules. And now you do. Welcome to the game.